Property is one of 5 measures used by Vitality Money to assess your current financial position. Property and retirement, which we'll get to in another video, are the 2 measures that track your progress towards financial independence. Because once you stop working, we want your home to be paid off or for you to have enough income to keep a roof over your head and cover your lifestyle expenses. To be financially independent, you need to be deliberate when it comes to property and secured debt. When you borrow money to make a purchase that a lender could take away if you don't pay them, that's secured debt. Most people take out as much debt as the lenders will give them. A smarter approach is to buy within the context of your affordability. The more money you spend paying off debt, the less you'll have to spend or invest. Don't compromise your financial future by overspending on a house or even worse, a car. That way, when you retire, you'll either have a paid-off property to live in or you'll own assets that can generate enough income to cover your accommodation expenses. To retire comfortably, you need to make sure that you have no secured debt repayments, like car repayments when you stop working. Settling debt in retirement will really detract from your quality of life. Vitality Money can help you make sure this does not happen. Your property points measure how you're tracking towards retirement, so you can stop working, have a place to live, and no secured debt. There are 2 ways the points are calculated, depending on whether you own or rent the place you live in. If you own your home, the points are calculated by looking at how much outstanding secured debt you have and comparing it to an age-related benchmark. This means that as you get closer to retirement, more of your property should be paid off. If you rent your home, the points calculation will consider investments not included for your retirement lifestyle funding, which can be used to cover your accommodation expenses. In other words, we're making sure that you can comfortably afford to continue renting in retirement. Vitality Money uses an age-related benchmark to work this out too. There are 2 ways to boost your points: pay off your secured debt every month and build up your savings. It helps to be aware of common financial mistakes that could get in the way of boosting your property points. For example, a lot of people never own their house outright because they upgrade it every 7 years or so. Upgrading your house too often and spending more than you need are very common mistakes. But maybe the worst mistake is overspending on a car. You could really benefit by just choosing to drive a more affordable car. For example, if you bought a house for 1 million rand and a car for 300,000 rand, replacing your car with an equivalent every 5 years, your bond payment would be around 9,600 rand a month for 20 years and your car payment 6,700 rand a month for 5 years. Consider if you chose to buy a different car, one that costs just a third less than you were originally going to spend, and your monthly car repayment drops to about 4,400 rand. If you put the difference between those 2 car payments into your bond instead, you'd pay off your house in only 12 years and save 580,000 rand. And here's an even better financial gain. For the 8 years after paying off your house, you'd have an extra 14,000 rand available to invest every month. That's a massive impact on your long-term finances simply by choosing to spend less on a car. Building wealth is a balancing act. Choosing to manage your lifestyle expenses in favor of financial independence can result in unbelievable cash flow, and this cash flow gives you options. To retire comfortably, you need to pay off all your unsecured debt. You need to either own the property you live in or have enough investment income to cover your accommodation costs. It can be done, and your property points are a great tool for tracking this goal.